The September Canadian inflation data came in better than expected. The latest inflation data is up 2.4% on a year-over-year basis from the estimated 2.2%. Let's get more on this from Jimmy Jean, chief economist and strategist at Desjardins. Jimmy, thanks very much for joining us today.
Thanks for having me.
Your thoughts on the numbers we're seeing today, that first one, the 2.4?
Well, you're seeing an acceleration, but an acceleration was also expected. It's just that the acceleration is a little bit above what was expected. 2.4%. Still, I would argue, not too far from the Bank of Canada's ultimate objective of 2%. And looking into the details of the report, what we're seeing mostly is that you have some stickiness in food inflation. So food inflation at 3.7%. That's 1.5 percentage points above the long-term average. So it does echo the warnings from grocers when those retaliatory tariffs were reduced, to the effect that it would take some time before we would see some relief at grocery stores. I think that's one of the stories. Then you're seeing some volatility in travel-related components. We're getting less help as well this year from telephone services. Last year, that was a big disinflationary help. Now it's just sort of back to normal. But given that you're getting less support from that, it contributes to that sort of state of thickness. But I would say overall, those surprises, you look back the last couple of years, at least 2 or 3 times a year, you do get a surprise in that direction. And that doesn't mean that the general trend hasn't been towards lower inflation. And I think that story is still intact.
And what signs of optimism are you seeing? You were talking about food being up again. Any indications that might be slowing down, or we might see a drop coming up?
Well, those retaliatory tariffs that are hitting a number of categories of products, but certainly in the food sector, those have been removed. And over time, as the effect gradually filters through the supply chain, it should provide some relief on that front. And then there's another, when you think about the outlook, which is, I believe, what the Bank of Canada should more and more be focusing back on. You're seeing its own survey revealing that pricing intentions remain weak. You're seeing the latest job numbers that show wages are slow. You're seeing more longer-term unemployment. You have weak population growth as well. That's contributing less to the consumer spending outlook. So all those factors, I think, mean that the Bank of Canada can be relatively confident that inflation will remain in check, even though there could be some speed bumps down the road.
And what about the other big ones that people always want to look at that have an impact on the individuals? Housing, fuel, things like that, the day-to-day that you have to have. How do they do?
Yeah, well, you're seeing, gasoline was expected. The pop that we saw was entirely expected. You are seeing a bit of pressure in rents. So I would say there's stickier than they were perhaps early in the year. But when you look at the provincial breakdown, it's mostly in Quebec. And Quebec has a very different rent control scheme relative to other provinces. And as part of the formula that Quebec uses, it produces a higher rent. So that's not entirely unexpected. And quite in fact, they are going to review that formula in order to reduce those pressures coming from the rent side. But again, what matters is really the fundamentals, and you have weak population growth, particularly for students, which tend to be renters more than they are owners. So those, I think, over time will continue to participate in making those rent numbers lower. You also have surprisingly strong construction in housing starts, in particularly in the purpose-built apartment front. And that's also the added supply contributes to rent being more in check. So again, if the Bank of Canada slowly but surely adopts a more forward-looking approach, it will, I think, consider that this is still inflation is still likely to be in check going forward, and that it can proceed with further rate cuts.
Okay, and what can you see? What do you see the bank doing? We saw that report yesterday. There was pessimism. What do you see the bank doing now, next week and into the end of the year?
Well, I think the Bank of Canada next week will announce another rate cut, and bear in mind it will still not be in accommodative territory. It will still have rates in a neutral setting. And then I think, our baseline right now is for the Bank of Canada to continue with an additional cut by the end of the year. We will take stock of upcoming numbers, either on the economy, the impact of tariffs, of course, but also on inflation, whether we see confirmation of a reflationary trend or whether this report that we saw today was just a speed bump as we've seen in the past. And provided that it was, I think the Bank of Canada will still have the go-ahead to cut rates again.
And now we're hearing the possibility of a tariff deal involving steel, aluminum, and metals between the U.S. and Canada. What kind of an impact might that play with the bank, or will there be one?
Well, that would certainly be a major relief on when it comes to certainty. We're not in a recession, but we're certainly in a certainty crisis. So if that happens, that will be encouraging, and the Bank of Canada will be reassessing and reorienting its forecast accordingly. It already produced the de-escalation forecast, and back in July, showing weaker inflation, and we estimated that just the counter tariff removal would add a little bit to Canadian GDP, but certainly if we were to get a substantive deal on that front, that would be a big game changer when it comes to exports and certainly business investment in Canada. So we'll wait to see the details, and I think the Bank of Canada is in the same position.
Okay. Jimmy John, thank you as always for joining us.
Pleasure. Thank you.
Jimmy John is the chief economist and strategist at Desjardins.